back at it again. Nvidia dropped after Nancy Pelosi sold her shares, so let's look at the change. Sorted by change. Oops. Uh-oh. Browser froze. Son of a bitch. Oh, there you go. Moderna, JetBlue, Tesla. Wow, Tesla took a hit. PDD. PDD. Is this PDD holding Cleveland, New Gold, Super Micro Computer, da da da. Let's take a look at this. Okay. All right. Take a look at Peloton. What the hell is Peloton? I don't know that one. I know Walgreens. Let's take a look at Walgreens. Still not a good time to buy. It looks good, granted, but then I wouldn't buy on this. I'll wait till it stabilizes. One of those like stable buyers. I don't know most of these. Quantum Corp, Archer Aviation. Oh shit. Wow. I remember looking at it when it was yeah, when it was $3. Look how high it has risen. Shit. BlackBerry. That's still heavily traded. PG&E. Huh. I thought they went out of business. I thought they filed for bankruptcy. But, you know, guess like those, like, they were blamed for a lot of the, what is it, the fires. It's actually kind of crazy. Like, this is what happens when you're a honest company. Because I remember when PG&E was accused, they were just accused of setting forests on fires with their power lines or gas leakage. But it turns out it was just an arsonist. It was like back in the what is it? Back in the like early 2000, like pre 2000, like 2018. I remember I was in college at the time. So much sediment at the bottom. But yeah, and then they just accepted the blame for some reason. Like, you're not really supposed to take the blame unless there's, you know, like evidence without a reasonable doubt. But then they just took the blame without proof, and then their stocks crashed. And then like not until like 3 months later, it was found out, oh, it was caused by someone else. But then people still have that sentiment towards PG&E where they, like, yeah, we know it's not your fault, but we have that thought of you, and that thought is stuck in our head forever. So that sucks. Simply said, just deny blame if you had the chance to, or you'll end up like this. But, I think if you're investing in the long term, you want to flip your stock, it might be a good time to buy in a few months, but it's too slow for me. I'm not about that. IKEA Carnival. It's, oh man, AMD. I can't wait for the revenue report to come out. Please don't fail, brother. Revenue report will skyrocket the stock. I bought it at 140 something. So I am super down. But then, according to the revenue report, or like sales wise, revenue, whatever, it's supposed to make the shit go up. So luckily, I don't need the money. You could imagine why people can lose money in stocks when they sell low is because they need the money for some reason. It's not that they're completely stupid. They know like holding it, it will eventually like it's like one. Just imagine this: 113 is not the highest the price will ever be. The price will go up eventually. That's just a philosophy. Like it's look at the price and make a reasonable assumption that this is not the highest price that it will be forever. Starting today, got a cough, so. Oh, Ford, right? Yeah, I'm gonna. Yeah, you know what? Where's my phone? Okay. Let's look at for a 1 year standpoint. It's so crazy. This stock was like, I made some money off this one. Excuse me. Let's see. How many quantities total? So then that will be confirm. All right. Options. Single option, close option, condor, strangle. Wow. There's so many options like single, covered, straddle, strangle, vertical, butterfly, condor. What the hell is condor? The collar was stuck. Shit. This is some next level trading. Okay. Done. Hmm. Estimated total, credit, estimated transaction fee, da da da. Open statistics, options, da da da. Okay, I need to look this up. I forgot how to do call options on the mobile. Strikes 10.
Ladies and gentlemen, Webull has now enabled futures trading, and we're going to cover exactly what you need to know here in this video. A very big step, in my opinion, for Webull, but let's get into it. So, you're probably going to ask the question of, how do I even do this? What do I have to do? Well, there's a couple of steps that we want to cover before we get into it. So right now, I currently have the Micro E-mini Russell 2000 June 2024 contracts pulled up. What we're going to do is we're actually going to show you the Micro E-mini S&Ps today to show you an example, but we're going to get...
Okay, that's...
What's going on, guys? We are talking about... So, this is currently feature only for the Webull mobile app on your phone that way, or you can scroll down into... Let's see, where is it? I always lose it. It is under the trading section. There is a paper trading little icon. You'll click on...
I made $1,800 in 3 minutes last Friday trading futures, and I'm going to show you my exact strategy and what I did. Now, I did end up making another $1,000 later in the day, but we're going to go through all of these trades here and walk you through them. They are different trades, and I want to show you exactly what I did. So,
turbo...
one step further, and this will help you to decrease your risk and generate passive income. So I'm going to explain to you why stock market investor. In this video, you will see how people get rich with options trading. I will show you the math. I think that the best way to do this is running through an example, and I'm going to be honest with you from the start. This is my warning. You can make a lot of money with options, or screw it up and lose a ton of money. So if that sounds appealing to you, then strap yourself in and let's do this. First, let me clarify this. If you're looking for a tutorial on call options and put options, then please check out my other video. That is perfect for beginners. I will leave a link for you down below. Now let's do the math. So let's say that you have $10,000. You're flush with cash. With that $10,000, you have a choice. You can buy stocks or stock options. We'll run through two examples where you make a ton of money and another where you lose it all. So you're going to see how crazy this gets with stock options. I'm telling you, it's nuts. So let's use Yelp stock as an example, and we're going to work with real numbers. Just keeping it real. Yelp stock is at $36 a share. If you use your $10,000 to buy Yelp stock, then you can buy 277 shares. If Yelp goes up by $10 from 36 to 46, you make $10 a share. You have 277 shares, and you make a profit of $2,770. So congratulations. Okay, now let's do stock options. Yelp stock is at 36 a share. The 38 call option that expires in 1 month is trading for 80 cents. And keep in mind that these are real numbers. That means that a $38 call option will cost you $80. With $10,000, you can buy 125 call options. If Yelp stock goes from 36 to 46, then you will make a profit of $90,000. Now let's compare. Yelp stock went from 36 to 46 in 1 month. If you bought the stock, your profit is $2,770. If you bought the options, your profits is $90,000. Now listen carefully. I'm going to show you the math. If you get lost, or if you're already lost, then you need to watch my other video. The link is down below. Okay, so here's the math. Yelp stock is at 36. The $38 call option that expires in 1 month is at 80 cents. That means that one call option will cost you $80. Here's why. There are 100 shares of stock in each call option. You take the cost of 80 cents each, multiply by 100 shares, and that equals $80 for the call option. So with $10,000, you can buy 125 call options. Okay.
Okay. Let me see. 18 days. Da da da. Ew. Shit.
Now, if Yelp stock increases from $36 to $46 in 1 month, then the $38 call option price will be worth at least $8. So it's very straightforward. The stock went up to $46, right? And your strike price is at 38. That means that you have an $8 gain on each share. And each call option has 100 shares. So each call option is now worth $800. And you have to remember that you bought each call option for 80. And now each call option is worth 800. And you have 125 call options. Okay, so you started with $10,000, right? Now you have 125 call options. Each one is worth $800. That's $100,000. That means that you turned your 10,000 into 100,000 and you made a profit of 90,000. So this is how people get rich, by trading options. So this is a real life example of how a stock goes up by 28%, but you 10x your money. It's because stock options give you leverage, but it's a double-edged sword. So that's what happens when you get it right. If you get it wrong, then you can guess it, then you're gonna lose it all. So I wanna show you. Yelp stock is at 36, right? You buy the $38 call option that expires in 1 month. If Yelp stock does not go above $38 in 1 month, then your call options will expire worthless. And you lose your $10,000. In other words, to put it simply, there's a time limit. The call option has an expiration date. If you used your $10,000 to buy Yelp stock at 36, if Yelp stays at 36 after 1 month, then you don't lose any money. There's no time pressure when you buy the stock. You can hold the stock for years. There's no time limit. The problem with options is that you have a time limit, and that's risky because you need the stock price to do what you want it to do before the option expires. Otherwise, you are at risk of losing all your money. Now, if you want to buy a call option that gives you more time, let's just say 3 months or 1 year, you can. However, the more time on a call option, the more expensive the call option will be. If you want more time, it'll cost you. So that's the challenge with stock options. Time is against you. That's why options are high risk and high reward. And buying the stock is lower risk and lower reward. So I hope that clarifies.
Oh shit, wait. That I don't know. Options expire. Holy moly. Oh my god, I almost fucked with options. Holy shit. Oh my god, that's actually nuts. Yeah, see how many people are. Oh shit. Damn. God damn. No wonder people are losing money in the stock market. Everyone is trying to lose money. Oh man, I did not know that. Could have lost it all, bud. Could have lost it all. Wow.
What's the difference between buying $10,000 worth of stock versus stock options? Now, this is very important that you know this. You can use options to decrease your risk. So I use options to hedge and lower my risk. That is not what we covered in this video, clearly. So I just showed you investors love 80 cents. So if Yelp goes above $38.80 in the next 30 days, then you're going to be at a profit. So maybe, who knows, Yelp could go up to 40, it can go up to 42, maybe 50, it could go to 100. I mean, that would be unrealistic, but it's not impossible. If Yelp skyrockets, then you're going to make so much money because you're going to have the option to buy it at 38. So if you buy the call option, then you want Yelp to go up as much as possible, as fast as possible. Because if you think about it, it's very straightforward. If Yelp goes to $100, you can buy it for 38 and then sell it immediately for 100. So I just want to point out that that's the happy scenario where everything works out and you make a lot of money. But we have to talk about the flip side of the coin. We have to talk about how you can lose money and how you can get absolutely destroyed. So the danger is that you have a limited amount of time before your contract expires. And in that time, if the price of the stock doesn't do what you want it to do, in that set amount of time, then you're going to end up with a worthless contract. So I have to show this to you. So here's how that unhappy scenario plays out. Yelp is at $36 right now. You bought the call option to have the option to buy Yelp at $38. In the next 30 days, if Yelp is at $38 or below, then your contract is worthless. So I want to demonstrate the good and bad scenarios for you. There are 4 scenarios. So here's scenario number 1. Yelp is at $36 a share currently. You have the option to buy it at 38 within the next 30 days. And let's just say that the stock price, it goes down to $30. In this scenario, your contract is terrible. It's worthless. Why would you use your contract to buy Yelp at 38 when you could just buy it on the open market for 30? And remember, you paid 80 cents for that contract, so you wasted your money and you lose. So here's scenario number 2. Yelp is at 36. You have the option to buy it at 38 within the next 30 days. And let's just say that the stock price, it goes up to 37. In this situation, it's the same. It's the same thing. Why would you use your contract to buy Yelp at 38 when you can buy it on the open market for 37? So yes, the price of Yelp stock, it did go up. It went up from 36 to 37. However, it didn't go up enough because it's still below the strike price on the contract. So you wasted 80 cents to buy that contract. The stock went up, but not enough, and you still lose. Moving on to scenario number 3. So Yelp is at 36. You have the option to buy it at $38 within the next 30 days. And let's just say that Yelp goes up to $38.50. So in this scenario, you can buy Yelp for $38 and you could sell it for $38.50. So that is a gain of 50 cents. So congratulations. However, you still lose money because you paid 80 cents for the contract. So your true cost basis, it's $38.80 and you can sell it for $38.50. So you still lose, but at least it's not a total loss. So here's scenario number 4. So Yelp is at 36. You have the option to buy it at 38 within the next 30 days. Yelp goes above your cost basis of $38.80, and then you're going to be at a profit. The more it goes up, the more money that you'll make. So basically, in this situation, you want the price to skyrocket. For example, the best news would be Google decides to acquire Yelp for $60 a share, and Yelp stock, it skyrockets in price within your 30 days. Now, here's the thing. I want to tell you this because this is so important. With call options or options contracts in general, you can buy and sell them just like a stock. So in our example, if Yelp goes to $60 a share, you don't literally have to buy Yelp for $38 and then sell it for $60. You can just sell the options contract itself. But if Yelp is at $60 and you want to buy Yelp for $38 and just hold on to it, you can exercise the option and buy it for $38 and just hold on to the stock. And then your options contract, it'll disappear from your account, and then you'll end up with the Yelp stock. Now let's go back to the options screen. You buy Yelp for $38 and just hold on to it. You can exercise the option and buy it for $38 and just hold on to the stock. And then your options contract, it'll disappear from your account, and then you'll end up with the Yelp stock.
If Yelp is at
Is at $60 and you want to buy Yelp for $38 and then sell it for $60, you can just sell the options contract itself. But if Yelp is at $60 and you want to buy Yelp for $38 and just hold on to it, you can exercise the option and buy it for $38 and just hold on to the stock. And then your options contract, it'll disappear from your account, and then you'll end up with the Yelp stock. Now let's go back to the options screen. So I want to explain this whole option chain to you. That's what they call this. So you can buy call options at different strike prices. So let me tell you what is going on here. Okay, I want to ask you a question. It's pop quiz time. So I'm going to give you two offers. You tell me which one sounds better to you. Yelp is currently at $36. So here's my first offer. In the next 30 days, I'll give you the option to buy Yelp at $38. And my second offer, in the next 30 days, I'll give you the option to buy Yelp at $39. So which one sounds better to you? Of course, option number one sounds more appealing because I would rather have the option to buy Yelp at $38 instead of $39. Therefore, the contract at $38, a $38 strike price is more appealing. Okay, but here's the thing. These circumstances, they're factored into the price of the options contract. Now, I want you to compare the contract at $38 versus $39. The contract at $38 is selling for 80 cents. The contract at $39 is selling for 55 cents. So if you want to buy a contract with a higher strike price, the contract will be cheaper. That's because it's less probable that Yelp will hit $39 compared to $38. So in this case, they need to offer you a cheaper price. So take a look at the $37 strike price. That's trading for $1.15. That contract, it's more expensive because it's not that far-fetched that Yelp will go from 36 to 37 within the next 30 days. Now, I want to teach you about the duration of the options contract. So if you're thinking that this whole thing, everything that we're talking about, if you think that it sounds risky because, well, you don't know what's going to happen in the next 30 days with Yelp stock. If that's how you think, then I would say you're absolutely correct. I would agree with you because 30 days is not a lot of time. But what if I told you that Yelp is at $36, I'll give you the option to buy it at $38, but I'll give you that option for 7 months. So that scenario, it would be more appealing to you because you have more time for Yelp to go up. However, those favorable conditions, they're taken into consideration. Therefore, if you want more time on your contract, then you're going to pay for it. So take a look for yourself. I circled at the top your ability to choose the expiration dates of the contract. So we're using the same strike price at $38. For a contract that expires in 7 months, this contract is going to cost you $3.90. So compare that to the contract that expires in 30 days that's going for 80 cents. If the expiration date of the contract is sooner, then the contract will be cheaper. If the expiration date is farther out, then the contract will be more expensive. Now, I must clarify this one last thing because it's very important. Options contracts are for 100 shares. So if you buy one options contract of Yelp at a $38 strike price, then you're buying the option to buy 100 shares of Yelp at $38. And the contract price, it's quoted at 80 cents, right? So that's 80 cents a share. But you have to remember that you're dealing with 100 share increments. So if the options contract says 80 cents, then the options contract will cost you $80. So if you buy 5 options contracts, it's going to cost you $400. Now, I hope that this has helped you to better understand call options. Now, in this next segment, we're going to proceed to covered calls. So covered calls, we're still going to be dealing with call options, but we're going to be taking it one step further. And this will help you to decrease your risk and generate passive income. So I'm going to explain to you why stock market investors love covered calls, and then I'm going to show you how to do it. If you think that covered calls are complicated, they're not. I'm going to break it down for you nice and easy, and then you're going to become a much better investor in the stock market. And I just want to say that personally, I'm a big fan of covered calls because it gives me a steady stream of income. Now, let me tell you the good and the bad of covered calls. So the good thing about a covered call is that you will be paid income. Now, this could be weekly income, it could be monthly income, annual income. It's your choice. You get to decide. You make money by selling the call option. So I want to be very clear about this. In this scenario, you cannot lose money by selling the call option. So you could lose money on your stock, but you cannot lose money on the sale of the call option. It is guaranteed money. Even if you're a beginner, you will make money by selling the call option. But there's a trade-off. The bad thing is, when you sell the call option, you are limiting your upside potential if your stock goes up. So don't worry, I'm going to draw this out for you. I'm going to be very clear about this. I'm going to show you the math. Now, I want to clarify this for you. In the previous examples, we were dealing with call options and you are the buyer. We're still going to be dealing with call options, but in these examples, you will be the seller. There are 3 scenarios where you sell call options. Scenario number 1, you buy a call option and then you sell it. Scenario number 2, you sell a call option. And scenario number 3, you buy a stock and then you sell the call option. This is a covered call. So let me explain to you a covered call and how you make guaranteed income. And we're going to use a real life example, a real stock, the real price, the real call option prices. I thought that this would be best because I want to show you that this entire conversation is legit. We're going to be dealing with Intel stock, ticker symbol INTC. At the time of making this video, Intel is at $32 a share, a little bit over, but we'll call it 32 to make it easy. And we're going to use the Intel call option that expires in about 2 months. And that call option with a $34 strike price is selling for $1.50. So again, what I'm showing you is a real life example. So these are actual numbers. Keep that in mind. That's important because you're going to see how much money you can make and it gets kind of wild. Okay, so here's the situation. Let's say that you buy Intel at 32 and I give you an offer. So I, Brian, want the option to buy Intel from you at $34 within the next 2 months. So if you're going to give me that option, then you're not going to give me that option for free. So you're going to tell me, okay, Brian, if you want that option, then it's going to cost you $1.50. And I tell you that, okay, you got yourself a deal, let's do it. So I pay you $1.50 to have that option to buy Intel from you at $34 within the next 2 months. So in other words, you sold me a $34 call option that expires in 2 months for $1.50. Okay, so why would I do this? Why would you do this? Let's work out 4 scenarios and I'll show you the math. So scenario number 1, the share price of Intel goes down. So you bought Intel at $32 a share. And let's say that in 2 months, Intel falls in price by $2. It goes from $32 to $30. So in this scenario, I'm not going to use the call option that you sold me because why would I buy Intel from you at 34 when I could just buy it on the open market for 30? So in this scenario, you sold me a contract that turned out to be worthless for me. Okay, so for you, Intel falls from 32 to 30. You lose $2 on the stock, right? But you made $1.50 by selling me the call option. So you hedged and you're only down 50 cents instead of $2. So it's a good thing that, well, in this scenario, that you sold me the call option. Moving on to scenario number 2, the share price of Intel does nothing. So you bought Intel at 32. After 2 months, it's the same. Nothing happened. It's still at 32. In this scenario, you didn't make money. You didn't lose money on the stock. The price stayed the same. But you sold me the call option to buy Intel from you at 34. And I paid you $1.50 to have that option. But I'm not going to exercise that option because I'm not going to buy Intel from you at 34 because I could just buy it on the open market for 32. So in this scenario, congratulations to you. Your stock did nothing and you made $1.50. And let me tell you, making $1.50 in this type of transaction in 2 months is not bad because $1.50 divided by 32, which is what you paid for Intel, that's a gain of 4.6%. So you made a gain of 4.6% in 2 months. So if you annualize that, that's a rate of return of 28%. And again, these are real numbers. So this is how awesome options are, and the results get even better in the next scenario. So I'm going to show you. Scenario number 3, Intel goes up by a little. So you bought Intel at 32. Let's say that Intel goes up from 32 to 33. In this scenario, you made money on the stock because Intel went up from 32 to 33. Additionally, you sold me the call option to buy Intel from you at 34. But the share price of Intel is at 33, so I'm not going to exercise my option because even though the stock price went up, I would rather buy Intel in the open market for 33 rather than buy it from you for 34. So this is an awesome scenario for you because you made $1.50 by selling me the call option and your stock went up by $1. So you're up $2.50 in 2 months. That's a 7.8% gain in 2 months. Annualized, that's a rate of return of 46.8%. Scenario number 4, the price of Intel shoots up. So you bought Intel at 32. Intel shoots up, let's just say from 32 to 40. So you have to remember that you sold me the option to buy Intel from you at 34 within the next 2 months, and it shot up to 40. So you know what I'm going to do? You know what I'm going to do with the call option that you sold me? I'm going to use it. I'm going to exercise it. I'm going to buy Intel from you at 34, and I'm going to sell it on the open market for 40. So even though the price of Intel shot up to 40, you are forced to sell it to me for 34. So that was the contract. That was the deal. I paid you $1.50 for that option. So you bought Intel at 32. You sell it to me for 34. So you make $2 of gain on the stock. And I paid you $1.50 to buy that call option from you. So you make $1.50 there. You walk away with a gain of $3.50 in total. That's an 11% gain in 2 months. Annualized, that's a rate of return of 66%. That's pretty awesome. Now, with that being said, I want to ask you a question, and just think about this honestly. Would you be upset if this happened to you? Because you made an 11% gain in 2 months, but if you never sold the call option, then your stock would have went up from 32 to 40, and you would have an $8 gain on the stock. But you did a covered call, and you made a total gain of $3.50. So you sold yourself short. You still made money, but you would have made more money if you never sold me the call option. But of course, you didn't expect the share price to go up so high so quickly. So I guess it's just a matter of your point of view, whether you'd be kicking yourself or not over the situation. But that is the risk of writing a covered call. Again, you cannot lose money by selling the call option. The downside is that you are limiting your upside potential. Okay, so I hope that you're still following along. I hope that this is all clicking. But I have to show you 2 very important variables with covered calls: the strike price and the duration. But first, if you're finding this helpful, please give this video a thumbs up. I'm just trying to the call option has, the more expensive the call option will be. And that means that you as the seller would collect more money. So let's look at the call options on Intel 6 months out instead of 2 months. And here are the prices for the call options 6 months out. As you can see, the $34 call option 6 months out is selling for $2.61. So if you sell that call option, then you would receive $2.61. But here's the thing, you may be thinking, okay, but you can sell the $34 call option 2 months out and make $1.50. So over the next 6 months, why not just sell the $34 call option for $1.50 every 2 months? That way, you'll make $1.50, $1.50, $1.50, and then after 6 months, you'll end up with $4.50. So that sounds better than selling a single call option 6 months out and making $2.61, right? So that would be true if 2 months from now, the $34 call option were still selling for the same price at $1.50. And then 2 months after that, if the call option was still selling for $1.50. So in that scenario, yes, you would make more money by selling a 2-month option and then another 2-month option and then another 2-month option instead of selling a 6-month option. However, the price of the call option is constantly changing. If the stock price of Intel falls from 32 to 28, the $34 call option 2 months out would probably sell for around 50 cents or even less. So that's the risk that you're taking by going with a shorter call option. If you lock yourself into a longer call option, then you know how much you're going to make in 6 months. If you go with shorter time frames, then you don't know how much that $34 call option will be selling for when the time comes. You may get a better price, you may get a worse price. So that's the risk. Now, let's change another variable. Let's change the strike price. So you can sell the $34 call option 2 months out and make $1.50. Or we can change the strike price to 38 and sell that option for 50 cents. If you go with a higher strike price, then you're giving yourself more upside potential to make money on the stock in the event that your stock goes up. So just think about it. You're guaranteed 50 cents in 2 months' time. If Intel shoots up to 38, sure, you're going to make less money by selling the call option because you're only going to make 50 cents instead of $1.50. But you're going to make more money from the stock going up. Because if Intel shoots up to 38, you're going to be forced to sell Intel at $38. But if you sold the $34 call option, then you would be forced to sell Intel at 34. But you probably realize the downside. If you bought Intel at 32 and it did a whole bunch of nothing, let's just say that after 2 months, it stayed at 32. Well, if you sold the $34 call option, then you could have made $1.50. Instead, if you sell the $38 call option, then you're all going to make 50 cents. That's the dilemma. So for the call option, the closer the strike price is to the current price, the more expensive the call option becomes. The farther the strike price, the cheaper it becomes. Okay, now let me show you how to write a covered call. In order to write a covered call, you need to buy the stock first and then sell the call option. So do not buy a crappy stock because you don't want to make money by selling the call options but lose money on the stock. So that's like dropping quarters to pick up pennies. So find a good stock that you think will go up. And if you remember, with options, you're dealing with 100 share increments. So in this Intel example, in order to do a covered call, you need to buy 100 shares of Intel first, and then you sell the call option. So let's just say that you already own 100 shares of Intel. In this scenario, you would just place a single order. Sell to open, one contract.
Sell to open. Oops.
Select the expiration date and the strike price, the price of the option, and that's it. Piece of cake.
Easy.
Okay, very easy. If you have 500 shares of Intel and you want to write covered calls on all 500 shares, then it's going to look like this. Sell 5 call options. And just so you know, you don't have to write covered calls on all your stock. If you have 500 shares of Intel, you can write 1 contract, you can write 3 contracts, whatever you want. And you're going to notice that it says $750. That's how much money that you're going to make from selling 5 covered calls. So here's the math. The $34 call option is selling for $1.50. So that's $1.50 a share. Multiply that by 100 shares, and that's $150 for each call option contract. Multiply that by 5 call options that you're selling, and you make $750. $150 a contract times 5 contracts equals $750. So as I said to you before, you need to buy the stock first and then sell the call option. But I want you to know that many brokerage accounts will allow you to buy the stock and sell the call option at the same time. So it'll be simultaneous. So it would look like this. You're completing two actions at the same time. Buy the stock, sell the option. Now, let me finish by telling you what happens after you write the covered call. As soon as you sell the call option, you receive that money immediately. So if you sold the $34 call option, $2 months out for $1.50, which would equate to $150, then you would receive that $150 in your account immediately. So it's automatic. It's going to appear in your account. It's going to appear there like magic. So you don't have to do anything. Now, after 2 months, let's say the price of Intel ends up at 35, which is above your $34 strike price. Then you would be forced to sell your Intel stock at 34. And your Intel shares would be sold automatically. You don't have to do anything, they take care of it for you. If the price of Intel ends up below 34, then the call option that you sold expires worthless and it's automatically eliminated. So you don't need to do anything, your brokerage account takes care of everything for you. And you have to remember that you got paid upfront for selling the call option. Now, I want to give you these last tips. The premium is a fancy way to say the price of the options contract. So if the $34 call option is selling for $1.50, then $1.50 would be the premium. If you're selling the option, the more premium, the better, because as this, they're like magic. So you would be sold automatically. You don't have to do anything, they take care of it for you. If the price of Intel ends up below 34, then the call option that you sold expires worthless and it's automatically eliminated. So
Hey, for call options. Ugh. Yes. No, that one.
you don't need to do anything. Your brokerage account takes care of everything for you. And you have to remember, not be forced to sell automatically below 34. Then the
Oh, okay. Let me see. All right, time to work out.
up.
PR time.
Ugh. Ugh. Shit. Oh my gosh. Ugh. Those guys are scary. Oh hell. Yeah, because my hands look like deadly weapons when they're stiff, when they're tense. My hands look like deadly weapons.
Dream, she can drool. Very humble. You just got took a step. No, I'm done with her.
Bandido safado, picada de cafajeste. Papo, eu falo que amo. Talvez eu não preste aqui na profissão perigo. A regra vou te ensinar. Cuidado com o amor, porque ele pode te matar. Depois que senta, ganha o bloco e o delete. Depois que senta, ganha o bloco e o delete. Cara de bandido safado, pegada de cafajeste. Papo, eu falo que amo. Talvez eu não preste aqui na profissão perigo. A regra vou te ensinar. Cuidado com o amor, porque ele pode te matar.
10 minutes a day, and I make
dropping, but I'm still standing. I ain't gonna give up, taking that damage. Cause I'm running to the flames and I'm fighting to the madness. Always on the execution, always on the action. So I ain't never gonna break when I make it the disaster. When I make it, 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 make it the disaster. Damage, it truly is a reason that they call me a savage. Yeah, I'm doing all the things that they cannot imagine. Doing everything it takes cause I'm really gonna have it. Yeah, I'm doing all the things that they cannot imagine. Imagine, yeah, 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 imagine, doing all the things, yeah, imagine, yeah, imagine, yeah,
do it, yeah.
strength. Oh. All right. Charming. It's just me. He doesn't. Watch some anime while I work out my forearms. Alright, let me warm them up.
だ残ってたのか、羽鳥。もう帰らないと怒られるぞ。
原田さんだってまだ残ってるじゃないですか。
俺は進路相談の面談があったから。
原田さん、本当に引退しちゃうんすね。留年すりゃいいのに。
こらこら、縁起でもないこと言うな。
俺、原田さんの背中しか見てないんですよね。
背中？
演奏の時、俺はあんたの後ろにしか座ったことがないってことです。これが最後のチャンスなんで、食わせていただきます。
3年生は基本オーディションには。
鮎川は実力のあるやつなら前に出す。そうでしょ。
上ばかり見てると足をすくわれるぞ。
おやおや、ずいぶん買われてるんだな、あの二人は。明日か。
初めて演奏を聞いた時からうまいとは思ってたけど、なんか別人っていうか。
All right, N4. Hate the smell in my mouth. It's a strange smell in my mouth. I brush my teeth and it's still like I brush my tongue and everything. Maybe it's I just need to wash my face. No problem. I make like 500 a day, 200 no sorry 500 a week from stocks, 200 a week from my business.
おう。ほら、前にお前に話しただろ、バイオリニストの青野龍二の息子だろ。覚えてるよ。その子が今度お前んとこに入学決まってさ、音楽推薦で姿は見なかったが、一般入試で入ったんだよ。俺が勧めてさ。父親の存在がでっけえあいつには音楽以外でも自分はやれるってことに気づいてほしくてさ。本人にとってはいい迷惑だろうけど。だからまあ、もしあいつがオケ部に入ったらよろしく頼むよ。随分肩入れしてるんだな。そりゃするよ。俺はあいつのファンだからな。中1の時のコンクールで初めて演奏聞いたんだけどさ。その話は前に聞いた。ほら、音楽推薦ではすげえやつも入ってくるんだろ。佐伯。そう、佐伯。もしかしたらいいライバルになるかもよ。どうかな。昔の俺とお前みたいに勘弁してくれ。ああ、いいなこ
どうせもう一度戻りてえな。飲みすぎだぞ。よし、もういいぞ。次の人、アイレン。
そりゃ緊張するよな。みんなこの日のために毎日練習してきたんだ。懐かしいな、この感じ。
青野くん、緊張してる？
あ、
ちなみに私はめっちゃ緊張してる。
え、
ごめんね、急にこんなところで話しかけたりして。
いえ、
なんか喋ってないと落ち着かなくて。どのくらい緊張してるかっていうと、今すぐにでもトイレに行きたいくらい。
まだ順番来ないし、行ってきてもいいと思いますけど。
そうだよね、ちょっと行ってくる。
あんなその先輩初めて見た。
先輩がこんなだと幻滅するでしょ。
そんなことは。
私本番に弱くてさ、今年はこれでもマシな方なのよ。去年は吐きそうになって大変だったの。
そんなにですか。
でも不思議だよね。こんな状態になってでもオーディションでは負けたくないって思うの。行ってくるね。
頑張ってください。廊下に響くバイオリンの音がより一層部員たちの鼓動を大きくする。
ちょっとハル、大丈夫？大丈夫。多分。なんだ、昔からお腹弱いよね。お兄ちゃん、先戻っててもいいよ。平気。まだ順番来ないと思うから焦らなくていいよ。オーディションの音聞くと緊張しちゃうし。ねえ、青野くんと佐伯くん、どっちだと思う？佐伯くんじゃないの？去年バイオリンのコンクールで優勝したでしょ？でも2年生には羽鳥さんもいるし。そろそろ青野くんの番じゃない？聞きに行こうよ。そうね、行こう行こう。青野くんたちガーサになってるね。今回のオーディションで誰が前に座るか。そんなことより今は自分の心配。さあ戻ろう。
よし、もういいぞ。次、アイレン。では始めろ。佐伯とお前、名前は？
正直俺はこの先生が苦手だ。名前を覚えられていないこともムカつくけど、どこかあいつに似てるから。別に名前なんか覚えられなくてもいいんだけど、ただやられっぱなしじゃ気が済まない。
この演奏。公正に試験を行うため 誰が演奏しているのかがわからないよう審査する私たち3年生は演奏者に対し背を向けて聞いている。でもその場にいる全員が誰による演奏なのかを瞬時に理解した。びっくりした。一瞬原田くんの演奏かと思った。
どうした原田。てっけえため息ついて。
ああ、ごめん。
どうせオーディションのことでしょ。
やっぱり弦のオーディションの審査員やりたかったなって思って。
しょうがないよ。公正な審査をするためあえて弦楽器の審査員は管楽器のパートリーダーがする決まりなんだよ。
同じように管楽器の審査員は弦楽器のパートリーダーだしな。
ああ、もちろん管楽器の審査もすっごく楽しみだよ。ただやっぱり普段から近くで見ている彼らがオーディションではどんな演奏をするのか気になってね。
原田くん楽しみにしてたもんね。
こうしてソロで弾くのは久しぶりだな。久しぶりで少し舞い上がっている自分がいる。
次私に貸して。違うよ、次は僕だよ。はじめ、ブランコ乗りたいんでしょ。僕にも乗らせてって自分で言わなきゃ貸してもらえないよ。この子女に控えめでいいのかしら。バイオリン弾いてる時とは大違いなんだよね。ちょっと優しすぎて心配。
いいんだよ、こいつはこれで。本当の初めはバイオリンを弾いてこそ見られるんだ。な、はじめ。
なんで今こんなことを思い出したんだろう。あの時はあいつが言った言葉の意味を理解していなかったけど、今ならそれがわかる気がする。
雄弁だな、演奏が言っている。
俺を見ろ。
おいおい、マジかよ。
青野くん緊張してる。
すみません先輩、正直俺1ミリも緊張してないです。緊張どころか
このテンポで弾いてみろ。
鮎川先生が指揮を振ってる。振り向きたい。
この演奏青野くんだよね。やっぱり君は。
結果って今日発表じゃないの？なんだ、ドキドキして損した。まだ管楽器のオーディションがあるからね。
あれ、佐伯は？
あいつならもう帰ったぜ。疲れたから早く帰るってさ。
何？佐伯がやっぱ気になる。
理してみんなに配る。
何ですかこれ。
オーディションの結果だ。
座席をもうできたんですか。
早く原田に見せてやれ。あいつが一番首を長くして待ってる。
これはまた面白い結果になりました。
Call option that you sold expires worthless and it's automatically eliminated. So you don't need to do anything. Your brokerage account takes care of everything for you. And you have to remember that you got paid up front for selling the call option. Now, I want to give you these last tips. The premium is a fancy way to say the price of the options contract. So if the $34 call option is selling for $1.50, then $1.50 would be the premium. If you're selling the option, the more premium, the better, because as the seller, you want to get paid more money for writing the contract. In terms of how options are priced, I want to explain this to you in a nutshell. More time on the contract means more premium. The closer to the strike price means more premium. The more volatile a stock is means more premium. So regarding volatility, this makes sense, because just think about it. If a stock is going up or down like crazy, then you deserve to be compensated more for locking yourself into a contract at a certain price. Because who knows what's going to happen to the stock within your duration. So when you're looking to write covered calls, make sure that the deal makes sense. Because you have to remember, the downside is that you're limiting your upside potential during the contract's duration. So if the risk is not worth the reward, then don't do it. I know that the appeal of guaranteed income is great, but if it's not worth it, just don't do it. Use your best judgment. I trust you. And if you want to find good covered calls, it's like shopping. You have to shop around for good deals. Sometimes there won't be any good deals. Other times there will be a lot of good deals. So usually there are a lot of good deals on a lot of good stocks. Just use your best judgments and you'll get the hang of it. I hope that this has been helpful, and I want to tell you this. If you need to rewatch certain parts, please do so, because that is normal and that is expected. I'm just happy that you're taking the time to improve yourself and learn this to become a better investor, because this is going to be a game changer and it's going to give you more opportunities to make more money. We are now moving on to put options, and put options will be well, you can think of it as the complete opposites of call options, but I'm going to break this down for you nice and easy. I will explain to you what are put options, how you can make a lot of money with put options, and how you can lose a lot of money with put options as well. So let's start from scratch. What is a put option? A put option is a contract between a buyer and a seller. So let's pretend that I'm the seller and you are the buyer. So in other words, I am selling the put option and you are buying the put option. Now let's choose a stock. Dave & Buster's stock, ticker symbol is PLAY, play. Dave & Buster's is currently trading at $44.96, but to make it easier, let's just say it's $45 a share. And I want to make a deal with you. What if I told you, within the next month, I will give you the option to sell Dave & Buster's stock to me for $40 and I'll buy it from you. So you don't have to sell it to me, but you can if you want to. That is your option. But I'm not going to give you that option for free. If you want that option, you'll have to pay me 45 cents. And let's just say that you agree. You'll pay me 45 cents to have that option. So ultimately, you bought the Dave & Buster's $40 put option with a 1-month expiry for 45 cents. So it sounds fancy, but it's very straightforward. But you have to remember that right now, Dave & Buster's is at $45 a share. So you're not going to go buy it for 45 and then sell it to me for 40, because if you did that, then you would lose money. You would lose $5 a share, so you wouldn't do that. So the question is, how do you make money? So you want Dave & Buster's stock to crash within the next month. If Dave & Buster's stock falls to, let's just say $30 a share, then you would be so happy. Because if Dave & Buster's falls to 30 a share, then you can buy Dave & Buster's on the open market for 30, and then you could immediately sell it to me for 40. And then you would make a gain of $10 a share. And you have to remember that you paid 45 cents to have this option. Therefore, your true profit would be $9.55. So that would be an awesome rate of return because with 45 cents, you made $9.55. And I want you to know that this is a real life example. Those are real numbers. Take a look for yourself. This is the options chain for Dave & Buster's, ticker symbol PLAY. We go about 1 month out, we open that up, and you get this. So don't be intimidated. This is very easy to read. So we're looking at the $40 put option that's selling for 45 cents. You refer to the ask at 45 cents because if you're trying to buy the put option, the seller is asking for 45 cents. So you look at the ask. Now let me give you a different example to show you how you lose money. So let's just say that you bought the same put option. You bought the $40 put option expiring in 1 month. If Dave & Buster's does not fall below $40 in a month, then your contract will be worthless. So to demonstrate, Dave & Buster's is at $45 a share. Let's just say that the stock falls to 41. Then in this situation, your contract would be worthless. Because why would you exercise your option to sell it to me for 40 when you can sell it on the open market for 41? So if the stock does not fall below your strike price before the expiration, then you wasted your money on buying the put option. So in this example, you paid 45 cents for nothing and wasted your money. Now, I need to tell you about the duration of the contract, and I'll teach it to you like this. I'm going to give you 2 offers, and you tell me which one sounds better to you. Offer number 1. You can sell Dave & Buster's stock to me at $40 within the next month. Offer number 2. You can sell Dave & Buster's stock to me at $40 within the next 5 months. So you tell me which offer sounds better to you. And it's going to be offer number 2. Offer number 2 sounds better because you have more time for Dave & Buster's stock to fall below 40. However, this favorable condition, it's taken into consideration, and I'll show you. So take a look for yourself. Here are the options contracts on Dave & Buster's. For the put option 1 month out, the $40 put option is selling for 45 cents. Now I want to show you the same $40 put option, but 5 months out. So we open that up and we see this. The same $40 put option is selling for $2.40, which is a big difference compared to 45 cents. So regarding the duration, the more time on the contract, the more valuable the contract is, so the more expensive it is. Time equals money. So you can check the same $40 put option that expires in a week, and you're going to see that the contract will be cheaper. You can check the same $40 put option that expires a year and a half from now, and that will be much more expensive. Now, I want to tell you about the strike price. I'm going to give you 2 offers again, and you tell me which one sounds better to you. Offer number 1. Within the next month, you can sell me your Dave & Buster's stock for 40. Offer number 2. Within the next month, you can sell me your Dave & Buster's stock for 45. So which offer sounds better to you? So in this situation, of course, offer number 2 is going to be better for you because you would rather have the option to sell me Dave.
All right, workout done. And then stock shopping done. Now I'm gonna take a break. And watch some anime. Be right back.